Only people who get it are the people who get it. Welcome to today's e-learning journey, where we dive into the world of finance and explore the importance of liquidity management in credit unions. In this session, we'll demystify the concept of liquidity, understand why it's crucial for credit unions, and uncover strategies for effective liquidity management. By the end of this video, you'll have a solid grasp of why liquidity matters and how credit unions keep their financial engines running smoothly. Let's begin our journey with the basics, understanding liquidity in the context of credit unions. To comprehend liquidity management, we must first understand what liquidity is and why it's critical for credit unions. Liquidity is not the same as solvency. Liquidity relates to a credit union's ability to meet its short-term obligations, while solvency refers to its long-term financial health. Imagine your credit union is like a school cafeteria. You need enough cash, liquidity, to cover today's lunch expenses, but you also need to ensure you can pay for all the ingredients, solvency, for tomorrow's lunches. So, where do credit unions get their liquidity from? Credit unions gather liquidity from sources such as member deposits, interest income, and even borrowing from other financial institutions. Now, let's talk about liquidity ratios. These are like vital signs for a credit union's financial health. Think of them as your credit union's heart rate and blood pressure readings. They provide insights into its financial stability. Understanding liquidity is essential, but so is recognizing the risks associated with it. Picture a beautiful day, but you see storm clouds in the distance. That's liquidity risk, the potential financial storms credit unions must prepare for. Liquidity risk is possibility that a credit union won't have enough cash on hand to meet its short-term obligations. In other words, it's like promising your friends an ice cream party, but you're not sure you have enough ice cream in the freezer. Now let's dive into the factors that can affect a credit union's liquidity. These can range from a sudden surge in member withdrawals to economic downturns that impact investment returns. Managing liquidity risk is crucial, and credit unions have various strategies and tools in their toolkit. Think of it like preparing for those storm clouds. You might have umbrellas, a backup plan, and even a weather app to stay informed. But managing liquidity isn't just about being prepared, it's also about following the rules. Let's explore the regulatory framework. Credit unions must navigate a set of regulations and requirements related to liquidity management. Regulators set specific requirements for credit unions to ensure they have adequate liquidity. These requirements help protect members' interests and maintain financial stability. Credit unions must also comply with the reporting obligations to provide transparency to regulators. Imagine it's like submitting your school assignments. Credit unions need to submit their financial homework to regulatory teachers. Now that we explore the regulatory side of liquidity management, let's delve into best practices that credit unions follow. Managing liquidity effectively requires more than just meeting regulatory requirements. It involves adopting best practices. One key strategy is maintaining a diversified portfolio of assets and liabilities. Think of it like a well-balanced meal. You want a variety of ingredients to ensure a nutritious diet. To truly grasp these strategies, let's dive into the real-world case studies of credit unions. These credit unions have excelled in liquidity management, and we can learn valuable lessons from their experiences. With our exploration of liquidity management in credit unions complete, it's time to wrap up our journey. We've covered a lot in this e-learning session, and I hope you now understand why liquidity management is crucial for credit unions. To summarize, liquidity is the lifeblood of credit unions, ensuring they can meet short-term financial obligations. We've explored liquidity ratios, liquidity risk, regulatory frameworks, and best practices that credit unions follow. But remember, this is just the beginning. I encourage you to explore the world of finance further. It's like embarking on an exciting journey where you continuously learn and adapt. Thanks for watching.